Good afternoon, friends. Today we will discuss Unit 7 of International Financial Management, that is, management of forex exposures or management of currency exposure or management of currency risk or forex risk. First, let me tell what will be the structure of my discussion. First, I will give an introduction to the subject. Then we will discuss different type of forex exposure or forex risk. Next, we will discuss how to manage these exposures. The exposures are of three types: transaction exposure, operating exposure, and translation exposure. We will understand how to manage transaction exposure. Next, we will understand how to manage translation exposure. Next, we will understand how to manage economic exposure. And at last, we will discuss how to manage operating exposure. We will discuss all these things one by one. First, let me tell you what is risk. Normally, in finance, risk means fluctuation. Risk means variation. Risk means variability. When the currency value fluctuates or varies, then the value of cash flows associated with a MNC or assets or liabilities or equity or income or expenses also fluctuate. And this fluctuation is denoted as foreign exchange risk or currency risk. So what is forex risk? Foreign exchange risk is related to variability of domestic currency value of assets, liabilities due to unanticipated changes in exchange rate. When there is changes in exchange rate, unanticipated changes, it affects the domestic currency value of assets, liabilities, cash flows of an MNC, and this is known as foreign exchange risk or currency risk or forex exposure. Now, foreign exchange risk or exposure is linked with currency fluctuation that adversely influence different aspects of the company. What are the different aspects? The aspects may be assets, liabilities, equity, or income. So, forex exposure refers to the effect of exchange rate volatility. What is the impact of exchange rate volatility on firms' cash flow and firms' accounting figures? What is cash flow and accounting figure? Cash flow may be current cash flow or future cash flow. The accounting figures may be assets, liabilities, equities, incomes. And the impact of foreign exchange variation on these figures is known as forex exposure or forex risk. Normally, we can classify the forex exposure into three parts. What are the three parts? One is transaction exposure, another is operating exposure, another is translation exposure. Three important exposures: transaction, operating, and translation. Transaction exposure and operating exposure combinedly known as economic exposure. These are economic exposure. And translation exposure is known as accounting exposure. So this is economic exposure and this is accounting exposure. What is the main point of difference between these? Economic exposure involve cash flows. It affects cash flows. Whether it's transaction exposure or operating exposure, it affects cash flow. Transaction exposure affect current cash flow, whereas operating exposure affect future cash flow. So due to transaction exposure, due to fluctuations of exchange rate, if the current cash flow of the company is affected, that is known as transaction exposure. If future cash flows of the company is affected, that is known as operating exposure. And translation exposure is purely accounting exposure. It does not affect any cash flow. It does not affect cash flows, but it affects the valuation. It affects the valuation. It affects the valuation of assets, it affects the valuation of liabilities, it affects the valuation of equities. Hence, this is also known as accounting exposure or valuation exposure. So, transaction exposure or transaction risk, operating exposure or operating risk, translation exposure or translation risk. So, these are three basic type of foreign exchange exposure or forex risk. First, we will discuss regarding transaction exposure. What is transaction exposure? How this transaction exposure can be managed. First, transaction exposure is a type of foreign exchange exposure. It arises due to the transaction which has already been contracted for. So transaction exposure arises due to the transactions or agreements which has already been contracted for. Therefore, it is known as contractual exposure. Transaction exposure is also known as contractual exposure because it arises due to the contracts which has already been incurred by the MNC. The impact of currency fluctuation on the obligation which is already been taken, that is known as transaction exposure. Transaction exposure is associated with already committed transactions. What is already committed transaction? Transactions which has already been incurred, which has already been agreed. Those type of transactions give you transaction exposure. If those are expressed in term of foreign currency, if those are made in term of foreign currency, the fluctuation in the value of foreign currency will give transaction exposure if one condition is followed, that is if transaction date and settlement date, there are two dates, transaction date and settlement date are different. What is transaction date and settlement date? Transaction date is the day on which transaction is agreed upon. Settlement date on the day on which payment is actually made. If between these periods the exchange rate fluctuate, it gives to transaction risk. Exchange rate fluctuates, it gives to transaction risk. So transaction risk arises due to transactions already agreed upon, transaction risk. And if there is a difference between transaction date and settlement date, it gives rise to transaction risk. Okay, let's take an example. Suppose an Indian firm has entered into an import contract with a firm located in UK on August 1, 2022. There is an Indian importer, it has made an agreement with UK based exporter on August 1, 2022. The amount payable will be 1 lakh GBP or Great Britain pound. So Indian importer has to pay 1 lakh Great Britain pound for the export of goods, and the agreement is made on August 1, 2022. This is transaction date. Transaction date. The agreement is transacted upon this time, August 1, 2022. But the amount is to be paid on November 1, 2022. September, October, November. After 3 months, the payment is to be made. And November 1 is the settlement date. And there is a difference between transaction date and settlement date. And within this, if exchange rate fluctuates, then it will give rise to transaction exposure or transaction risk. At present, the Great Britain pound is trading 94.51 per Indian rupee. 1 pound is equal to 94.51. However, on November 1, 2022, the value of rupee per pound may shrink, means rupee may depreciate. If rupee depreciates and becomes 1 pound is equal to 99.91. On the day of transaction, pound was 94.51. On the day of settlement, the pound becomes 99.91. That means 99.51. That means there is a 5 rupees extra you have to pay per pound. And the transaction is for 1 lakh pound. So you have to pay how much extra? The importer has to pay 1 lakh into 5. 5 lakh rupees extra. And this 5 lakh rupees extra is known as transaction risk. You see, you have to pay 1 lakh pound and you also pay 1 lakh pound. But if you have paid 1 lakh pound on the transaction date, 1 pound would be 94.51. But on the settlement date, it becomes 99.51 because rupee value depreciates, pound value appreciates. And you have to pay 5 rupees extra per pound. So your transaction risk is 5 lakh rupees. This is known as transaction risk. Transaction risk arises due to transactions already contracted for. It affects the current cash flow of the business. Transaction risk affect current cash flow. Why it affect current cash flow? Because the firm has to pay how much extra? 5 lakh rupees extra. So it affect the current cash flow. You have to pay rupees 5 lakh extra now on November 1, 2022. So it is known as transaction risk or transaction exposure. Next we will go to second type of risk, that is known as operating exposure. What is operating exposure? What is operating exposure? Transaction exposure affect the current cash flow, whereas operating exposure affect the future cash flow. If due to fluctuation of exchange rate, the future cash flow of the MNC is affected, that is known as operating risk or operating exposure. So operating exposure is also a type of foreign exchange exposure. It is an impact of sudden currency fluctuation on a company's future earning and future cash flow. As it affects future earning and future cash flow, it is a long term in nature. Transaction exposure is short term in nature, but operating exposure is long term in nature. Operating exposure has an adverse impact on company's market value. It can adversely impact the market value of the company. It may impact the competitive position of the MNC. Hence, managing, hedging, operating risk is comparatively difficult than transaction risk. So, the level of operating exposure is directly linked with foreign exchange volatility or variability. It increases with currency fluctuation and decline with foreign fluctuation descends. Normally, MNCs face operating exposure because they are involved in numerous transactions in different currencies. If there is fluctuation in the value of the currencies, these MNCs are impacted due to currency rate fluctuations. That is known as operating exposure. Next one is translation exposure. What is translation exposure? What is translation? You know that there is a concept translation Hindi to English, English to Hindi. It's translation. Similarly, MNC normally operate in different countries. Let's take an example. Pepsi is an MNC. It has operations in 164 countries. PepsiCo, its headquarters is in US. Okay. And it has a subsidiary company, Pepsi India. Now, Pepsi India prepare its income statement, balance sheet in rupees. But Pepsi company prepare its income statement and balance sheet in dollar. Pepsi company has numerous subsidiary company. Now, at the end of the year, when Pepsi shareholder wants to know the group balance sheet, what is group balance sheet? That is consolidated balance sheet or consolidated financial position. What is consolidated financial statements? You have to inculcate Pepsi India, Pepsi Japan, Pepsi UK, all operations, income statement, position statement into Pepsi company, Pepsi USA balance sheet. That is, you prepare balance sheet for the entire group, Pepsi group. That balance sheet is known as consolidated balance sheet. You have to add the assets, liabilities, income of the entire group. But in all these cases, the assets, liabilities are in different currency. In Indian case, it is in rupees. In Pakistani case, it is in Pakistani rupees. In UK case, it will be in pound. So you have to translate, you have to convert rupee to dollar, you have to convert your Pakistani rupee to dollar, you have to convert pound to dollar, and you can prepare the group balance sheet. And while preparing this consolidated financial statement, if there will be fluctuation in exchange rate, then what will happen? Then in that case, practically the asset value may be same, but due to exchange rate variation, the consolidated figure will change. That is known as translation exposure. Translation exposure refers to impact of currency fluctuation on the value of asset, liability, equity, income of a firm. When a firm determines entirely or partially its assets, liability, equity, income in a foreign currency, the risk of translation exposure crops up. Translation exposure is an accounting exposure. It is a accounting exposure. It does not involve any practical gain or loss. It is only a book entry, book gain or book loss. Okay, and it affects the valuation of the firm. Hence, it is known as translation exposure or it is an accounting exposure. Let's take an example. Suppose an Indian subsidiary of American multinational company has earned 10 lakh rupees net profit. There is a Indian subsidiary of American MNC and it has earned 1 crore net profit. During the last year also, that means last year it has earned 1 crore and this year also it has earned 1 crore profit. At the present Indian rupee is 78.12 per dollar and the same was 74.17 per dollar. It means 2000, let's take an example, 2024, 2025. What is the profit? Profit was, let's 1 crore, profit was 1 crore. But in that case, 25, dollar exchange rate was 74.17, but now it has become 78.12. But in dollar term, profit will be 1 crore by 74.17. In this case, it will be 1 crore by 78.12. You just look at this. the profit in rupee form is same, but in dollar form it will decrease. Why it will decrease? Because the exchange rate has increased from 74.17 to 78.12. Though the profit amount remains same in Indian term, Indian rupee term, but in dollar term, it has reduced. So in consolidated profit and loss, it will show that Indian subsidiary in this year has done relatively poor performance in comparison to 2024. It will earn less profit what it has reported in 2024. But in rupee term, it has earned the same profit. But in dollar term, it has earned less profit because dollar value has appreciated during this year or rupee value has depreciated during this period. This is known as translation exposure. Am I clear? So, although the amount is still the same, but owing to rupee depreciation, it has appeared that the amount has decreased after conversion of US dollar. And this is known as translation exposure, or this is known as accounting exposure. So there are three important form of exposure. One is transaction exposure. It arises due to agreements which has already been incurred by the firm. And another is operating exposure. It arises due to future cash flow impact due to foreign currency fluctuation. Transaction exposure impact current cash flow, whereas operating exposure impact future cash flows. But translation exposure arises due to preparation of consolidated profit and loss and consolidated balance, where a subsidiary company's figure are translated into parent company's figure, parent company currency. So at that time of translation, the book value of profit, loss, or the book value of asset, liability, equity may change due to fluctuation of exchange rate, and that is known as a translation exposure. Now we will discuss how to manage these exposure. What are the techniques with which we can manage transaction exposure? What are the techniques with which we can manage translation exposure? What are the techniques with which we can manage operating exposure? First, we will discuss manage of transaction exposure. There are two techniques of managing transaction exposure. One is external hedging technique. External hedging. Another is internal hedging technique. These are the two techniques, external hedging technique and internal hedging technique. The external hedging techniques are of two types. What are the two types of external hedging technique? One is use of derivatives. What type of derivatives? Currency derivatives. And external hedging use of money markets. With the use of money market, we can hedge our exposure. So external hedging techniques involves use of derivatives and use of money markets. These are two important external hedging techniques. So normally there are two approaches of currency hedging. One is external hedging, another is internal hedging. First we will discuss how to hedge currency with the help of derivatives. So we will discuss hedging with currency derivatives. What are the currency derivatives? We know that hedging with currency futures, hedging with currency forwards, hedging with currency options. First, we will discuss hedging of transaction exposure with currency futures. We know what is futures. Futures are those type of derivative instruments which are purchased and sold in market. Which market? In exchange. These are exchange traded derivative futures. Okay, so you want to hedge your foreign currency risk. A company has foreign currency risk only when it has two things: either it has foreign currency payable or foreign currency receivable. Foreign currency payable or foreign currency receivable. First, we will discuss foreign currency payable. Next, we will discuss foreign currency receivable. If you have foreign currency payable, what does it mean? You have to pay something in foreign currency. So, in future, who are the person who has to pay something in foreign currency? Normally, the importers has to pay their bill in foreign currency. So importers will pay in future in foreign currency. So they have to buy foreign currency in future. They have to buy foreign currency in future. So when a party has to buy foreign currency in future, what is his major risk? His major risk is the buying price, future buying price may increase. So what he want to do? He want to fix the future buying price. Fix the future buying price with derivatives. So what he will do? He will buy currency futures. Buy means, I have told, buy means long. So he will be long on currency futures. So he will be long on currency futures. What strategy he will adopt? He will adopt long currency futures strategy. So if a person has foreign currency payable, he will go for long currency futures to reduce his risk. Okay, so he will buy currency futures to reduce the transaction risk. Next, if you have foreign currency receivable, who has foreign currency receivable? Receivable means you have to receive foreign currency in future, that is exporter. When they will receive foreign currency in future, what they will do? They will sell it in the market. So once they sell, they will sell foreign currency in future. So what is their greatest risk? The future selling price may be low. Future selling price may be low. If the future selling price is low, what they will do? They want to fix the future selling price. How you can fix future selling price? You can fix future selling price by selling currency future. So you will take which position in currency future? You will take short position in currency future. You will take short position. You will short currency futures. So I have discussed the concept. What is the strategy? The strategy is very clear. Strategy is, if you have foreign currency payables, you will long currency futures to hedge your risk. And if you have foreign currency receivables, you will short currency futures to hedge your risk. That means the importer will buy currency futures to reduce his risk. Exporter will sell currency future to reduce its risk. That is known as use of your derivatives or currency futures to reduce the transaction risk. Next one is, while using futures, you have to understand regarding three things. First, you have to decide the underlying asset, which future you will buy, what will be the underlying asset. You have to decide the date of expiry of the future, which month future you will buy, and you have to decide the number of contracts you have to buy the futures, how many contracts you will take exposure to reduce your risk. That is regarding hedging with foreign currency risk. Okay. Next one is hedging transaction exposure with forward contract. We know that there is no difference between forward and futures. Only those forward contracts which are standardized and exchange traded are known as future contract. But future contract of all currencies are normally not available. In that case, we have to make private arrangements for entering into contracts. Those privately made derivative contracts are known as forward contracts. So forward contracts are privately made contracts. Okay, in forward contracts, the terms and conditions of the contract is decided by the two parties involved. But the forward contracts are normally subject to default risk. Hence, the importer and exporter may use forward contracts for hedging, where the term and condition of the contract will be decided by the two parties involved in the agreement. And with the help of currency forward contract, you can prefix the future buying price or future selling price. So, importer and exporter, importer will buy currency forward to reduce his risk, whereas exporter will sell currency forwards. By buying currency forward, importer fix the buying price of dollar or foreign currency on a future date, and an exporter fix the selling price of dollar or foreign currency on a future date. So, currency forwards are used when currency futures are not available. In case of currency forwards, there will be always default risk or counterparty risk. Okay, next. You can use currency options. We have already discussed what is currency option. Option means choice. Option gives the holder the choice. The choice may be to buy something, or the choice may be to sell something. If the choice is to buy something, it is known as call option. And if the choice is to sell something, it is known as put option. Now we will discuss how to use call option and put option to hedge your currency risk. First, if you have foreign currency payable, you have to pay foreign currency. That means you are an importer. In that case, what you will do? You always want to pay foreign currency in future. You are concerned regarding rising in price of foreign currency. So in that case, with the help of option, you want to fix your maximum future buying price. You can fix your maximum future buying price with the help of instrument that is known as call option. So you will buy call option. If you are importer or if you have foreign currency payable, you want to fix the maximum future buying price, you can buy call option for that. Or you can adopt long call strategy. Second, if you have foreign currency receivable, what foreign currency receivable? Normally the exporter. Once they receive foreign currency, they sell it in the market and they are bothering that while selling, the future selling price might come down or fall. So in that case, they want to fix the minimum future selling price. How they can fix the minimum future selling price? In first case, it is maximum future buying price, and in second case, it is minimum future selling price. And they can fix it by buying which option? Put option. That is buy put option, or they can adopt long put strategy. So how with the help of option we can hedge our position? There can be foreign currency payable or foreign currency receivable. If it is importer, he wants to maximize, fix the maximum future buying price. So he will go for long call strategy or he will go for buying call option. And if it is foreign currency receivable, that is exporter, he is interested in fixing minimum future selling price. So he will do it by buying put option or he will adopt long put strategy. So with the help of long call or long put strategy, you can reduce the foreign currency risk, that is transaction risk. Okay. Next one is hedging with money market. How you can use money market instruments to hedge your risk? Without using derivative instrument, you can use money market instrument. Now please see, if you have foreign currency, suppose on a day on January 1, you have foreign currency receivable 2 lakh dollar. And if you have foreign currency payable 2 lakh dollar, your receivable and payable match on a particular date. In that case, what will happen? Your foreign currency risk is zero. Why it is zero? Because you receive 2 lakh dollar, you pay 2 lakh dollar. Whatever might be the dollar price, you are not impacted. Suppose dollar price is 80, so you will tell what is that? I will receive 2 lakh dollar, I will pay 2 lakh dollar. Okay, if your receivables and payables on a particular day are matched, then your foreign currency risk is reduced. So money market hedging, we apply the concept of this. If you have a foreign currency receivable, you create a matching foreign currency payable. And if you have a foreign currency payable, you create a matching foreign currency receivable with the help of money market and hedge your risk. So how it is done? First, if you have a foreign currency receivable, who has a foreign currency receivable? I have already told exporter. So exporter has a foreign currency receivable, he will create a foreign currency payable. How he can create a foreign currency payable? By taking a foreign currency loan. So he will borrow from foreign currency, then convert the foreign currency to home currency, and then he can receive foreign currency and pay the loan and hedge his risk. Similarly, if you have foreign currency payable, you have to pay foreign currency. You take a loan from domestic market, convert it into foreign currency, and keep deposit in foreign banks, so that on that day, on a particular day, you will have foreign currency receivable and foreign currency payable. In that case, the importer is required to borrow home currency, then convert the home currency to foreign currency using the spot market, deposit the money market, foreign currency in the bank, and at the rate make settlement. This is known as money market hedge. Okay. Example, suppose a company in Switzerland has imported a machine of $20 million. So a Switzerland, a importer is there, he has imported $20 million USD, and the payment is to be made after 90 days. So company has access to European money market, where both Swiss currency CHF and US currency USD are bought and sold. So how to hedge? Now please see, importer has foreign currency payable. Switzerland importer has foreign currency payable. So he will have to create a foreign currency receivable or foreign currency deposit. So what he does, he borrow from Swiss market from 90 days, convert the Swiss market, Swiss currency CHF to US dollar now, and deposit the same in US bank, earning a rate of interest. After 90 days, he will withdraw the US dollar and make payment to the foreign currency and repay the CHF loan. At the rate of this, by doing this, he will reduce the currency risk. So these are two important strategy of managing transaction risk. Next one is internal hedging strategy. There are two types of strategy: external hedging and internal hedging. Internal hedging strategy, there are 4 points. One is invoicing. What is invoicing? This is local currency invoicing. If you invoice your imports or export in your own currency, then you transfer the entire amount of risk to the opposite party. A company can shift the entire risk caused by foreign currency translation to foreign currency fluctuation to other party if it invoices its import as well as export in its domestic currency. That means an Indian importer will import a machinery from US and tell that I will make payment in INR. If you make payment in INR, there will be no currency risk. Second one is risk sharing. What is risk sharing? It is a clause, it is an agreement between exporter and importer. In that case, they agree that if the currency value fluctuates above a particular limit, the exchange rate risk will be shared between importer and exporter. This is known as risk sharing. It is a clause in the agreement between both importer and exporter, where the risk amount is shared. Next one is netting and offsetting. What is netting and offsetting? Netting means if you have a offsetting first, offsetting. So on January 1, you have foreign currency receivable and you have foreign currency payable. You have foreign currency receivable $1 lakh and you have foreign currency payable $1 lakh. what will your net impact? $1 lakh receivable, $1 lakh payable, net impact is zero and it is offset. Suppose on January 5 you have receivable $1,20,000 and you have payable $1 lakh, so you have net $20,000 of exposure, and this net 20,000 is known as netting. So netting means, offsetting means total risk is cancelled. Netting means for balance amount we design the risk hedging technique. Next one is leading and lagging. What is leading and lagging? Leading and lagging. What is leading? Leading means advance. Lagging means delay. Leading means advance and lagging means delay. And in order to know the leading and lagging technique, you have to know two things. One is hard currency, another is soft currency. What is hard currency? What is soft currency? Hard currency is the currency whose value is expected to rise, and soft currency is the currency whose value is expected to fall. Advance means leading means advance, delay means lagging means delay. Okay, normally we advance payables and delay receivables in hard currency. If you have some hard currency payable, you lead it, and if you have some hard currency receivables, you delay it. Opposite is the true. Advance receivables and postpone payables in soft currency. This is the strategy you should adopt to manage transaction risk. Next one is translation risk. What is translation risk? I have told that translation risk arises while preparing consolidated financial statement, while preparing consolidated profit and loss, consolidated balance sheet. There are four methods used for consolidation. One is monetary non-monetary method, another is temporal method, another is current account non-current account method, another is current rate method. What is monetary non-monetary method? Under monetary non-monetary method, the monetary items like cash, accounts receivable, payables, they are translated using current exchange rate. Whereas the non-monetary items like fixed asset, long-term investment are translated at fixed historical rates. Under temporal method, inventory is translated at historical rate only. Next, under current non-current method, the current asset and current liabilities are translated at current rate, whereas non-current assets and non-current liabilities are translated at historical rate. Under current rate method, what happens? All items except equity are translated at current rates, whereas equity is translated at the rate which is prevailing when it is issued. These are the four methods of translation. At the time of translation, there can be some risk. That risk is translation risk. And the translation risk, there must be managed, may be managed or may not be managed. Some expert tells that as it does not involve in any value, any cash flow, it should not be managed because it is a book risk. It is not actual risk. But some expert tells that though it's a book risk, it affects the valuation of the company. Hence, it must be managed. But there are certain risks attached with translation risk because it is uncertain to future earning. The earning of the subsidiary company is not certain. Then there is unavailability of forward and future contract for some currencies, for some subsidiary currencies. There is a task discrepancy for translation exposure. And if we want to manage translation exposure, we are incurring more and more transaction exposure. These are the 4 points why translation exposure must not be managed. Next, measuring economic exposure. Economic exposure is also known as operating exposure. Operating exposure and transactions exposures. Economic exposure or operating exposure normally affect the future cash flow of the business. When future cash flows, it affects the competitiveness of the business due to exchange rate fluctuations. So the real exchange rate fluctuation impact the competitiveness of the business. In order to manage this, we have to take some serious things. First, we have to measure it. We can measure it with the help of two techniques. Either you can do sensitivity analysis or you can do regression analysis. With sensitivity analysis, we mention all the scenarios in which what are the different type of cash flows and what will be the important scenario in which exchange rate may fluctuate, and we find out the risk, that is known as sensitivity analysis. With regression analysis, we find out the exact amount of operating risk by analyzing the past data. We take past data and we forecast the future on the basis of past data and find out the extent of operating risk or operating exposure. Now, operating risk can be managed, but it's very difficult to manage operating risk. Operating risk can be managed with the help of two strategies. What are the strategy for managing operating risk? Operating risk can be managed with the help of two strategies. First strategy is known as diversification strategy. Second strategy is known as modifying the operating policies of the business. These are the two important strategies which are used in managing operating exposure or operating risk. First, diversification. Diversification means do not put all your eggs in one basket. Diversification may be of two types. Diversification of operation. What is diversification of operation? You do not operate in one country. If a MNC operate only in one country, then any exchange rate fluctuation will impact it seriously. Hence, MNC try to operate in different countries. Previously, Infosys export were primarily concerned with USA. With US dollar depreciation, Infosys feel the pinch. Therefore, Infosys now try to diversify its exports to Japan, European countries, so that the currency risk can be managed. So first point is you have to diversify your operation. You have to source your raw material from different countries. You have to find out multiple sourcing operation and multiple areas, multiple countries in which you will find out customer for your product. With the help of this, you can, by diversifying your operation, you can manage future operating risk or risk of your future cash flow. First point is diversify operation. Second part is diversifying financing. Do not raise money from one country. Raise money from different countries, so that if we want to pay interest, the exchange rate fluctuation will not impact you so much. Therefore, nowadays companies are raising money from US market, UK market, Japanese market, many markets they are exploring to raise finance. With the help of ADRs, GDRs, American Depository Receipts, Global Depository Receipts, company are sourcing their funds from different countries. So diversification is the key to manage operating risk. By diversifying your operation, you can manage operating risk. Second one is changing operating policy. What is operating policy? Operating policy means day-to-day policies of your business, that is known as operating policy. And in by changing some operating policies, you can manage the risk. It can be by using lead and lag in payments. Lead means advance, lag means delay. You can lead certain payments or you can lag certain payments. Lead means advance, lag means delays. You can adopt lead and lag payments. You can share currency risk with customers. What are these two things? We will discuss. First, lead and lagging payments. If a company has payable in a strong currency and the currency is expected to depreciate, in that case, the payables are required to be lead and the receivables are required to be lag. If you deal in a strong currency and you have payables, then you should lead it. And if you have the receivable, you should lag it. And the contrary is true. Contrary means if you deal in a weak currency, your payables must be lagged and your receivables must be lead. This is most applicable in case of subsidiary and parent company relationship. Next one is sharing currency risk with customer. While you do business with foreign client, you try to develop a relationship with foreign customers. And you create a long-term relationship with the customer. And you tell that if the currency risk is so much in our business relationship, let's decide to share the risk between ourselves through trading agreements. If the currency value fluctuates beyond a particular limit, the risk amount may be shared between two parties. That is known as risk sharing agreement with trusted, loyal customers. These are the techniques with which you can manage your operating risk. So in our last class, let me summarize my discussion. First, we have discussed regarding in today's class foreign exchange exposure or foreign exchange risk. Foreign exchange exposure or risks linked with currency fluctuation. With the help of currency fluctuation, the current and future financial transactions, asset, liability, equity, income, value changes. And this change leads to forex risk or forex exposure. The forex exposure may be of three types: transaction exposure, operating exposure, translation exposure. Transaction exposure and operating exposure combinedly known as economic exposure. They affect the cash flows of the business. But translation exposure is an accounting exposure. It does not affect the cash flows of the business. Rather, it affects the valuation of the business. It affects the asset value, liability value, equity value, income value of the business. Next, we have discussed what are the techniques of managing transaction exposure. There are two techniques: with the help of derivatives, derivative hedging techniques, and with the help of money market, you can hedge it, that is money market hedging techniques. Next, we have discussed translation exposure. It is an accounting exposure. Management of it requires certain risks certain precautions why you should manage, why you should not manage it, and why should you manage it. We have discussed all those things, and at last we have discussed operating exposure and how operating exposure can be managed by changing two important things, that is diversification and changing the policies. These are the activities and these are the self-assessment question. What is forex exposure? Different type of forex exposure. Distinguish between transaction exposure, operating exposure. What is translation exposure? And how future contracts is used for translation risk. All these things you can read, and these are the references I have followed, and these are certain suggested textbook to know more regarding this subject. Thank you. Thank you for attending my class. Thank you all.